Hello, welcome to our financial planning workshops. My name is Fred Smith with the local Silicon Valley chapter of the AAII, the American Association of Individual Investors. And before we start, we have our standard disclaimer here, which basically says that all the views expressed here are mine and not necessarily those of AAII National or the local chapter. This workshop is part of a series. The full cycle is shown here, where we cover the five pillars of financial planning, which include investing, retirement planning, taxes, risk management, and estate planning. And we've been doing workshops on those over the past few months, and today we're going to be doing a summary of all that we've learned and covered during those times. We start off with the investor's universe. Or at least my example of it, the way I look on it. At the bottom, we have a timeline that stretches from years or even decades on the left through months and weeks out to days on the far right. And anybody who follows modern portfolio theory would probably have built a diversified portfolio that they'll rebalance on a regular basis, and they will be down here in the bottom left corner. As you go up the timeline, you cover contrarian strategies, which include value investing, and those folks who believe in investing primarily in dividend stocks. And then momentum strategies, which include growth investing, usually stock picking, maybe market timing, this kind of thing, and speculation in the top right-hand corner for the day traders. I regard it as speculation. They don't necessarily do that. And some of the day traders actually trade multiple times per day. But it's important to understand where in this whole spectrum you're more comfortable, where you fit in. And the easiest way to find that is to work through the five-step investing process. The first thing you do is write a personal investor profile, a PIP. And that should include your age, your time horizon. If you have a risk tolerance questionnaire you've filled out, or even multiple ones from different financial institutions, that this would be a good place to include the results of that. It should include your tax brackets and which accounts are taxable and which aren't, stuff like that. It answers the question, who am I? And it's a definition, a personal definition. The next item is your investment policy statement, the IPS, and that answers all the other questions, the what, where, when, how of investing. It should include your goals, what asset classes you want to use. Are you just for equities? Are you splitting it into small cap and large cap and stuff like that? Are you going to include commodities? And what other asset classes will be in your portfolio? Then you have to figure what asset allocation you use. How much do you allocate to equities? How much to fixed income? And this is basically goes back to your risk tolerance and where you fit on that scale. It should include your trading rules. You should define here under what circumstances you buy a stock or a fund, and under what circumstances you sell it. What stimulates a trade. And also for if you're a passive investor, what are your rules for rebalancing? Do you do it on an annual basis, or do you do it when the asset allocation gets out of kilter by a certain amount? And having done all of that, you then are ready to do the easy part of it, which is designing the actual portfolio. Now that you've defined what you want to do, that involves picking the specific securities that go against each of the asset classes that you've defined in your IPS. Implementing the portfolio, you just go online these days to do that. It's very straightforward. And having done all that, the only thing that remains is that you need to monitor it on a regular basis. And regular really means as defined in your policy statement. If it's a passive approach that you're using, then you may find that rebalancing it once a year is just fine. If you're doing a more active approach, you need to go back to your IPS and use that to decide under what circumstances you're going to do any rebalancing or make any trades. Let's look very quickly at the concept of passive portfolios versus an active one. First of all, the sum of the passive investors plus the active investors represents the total market. The total market is made up of the sum of these. I've defined a passive investor as somebody who builds a diversified portfolio using cheap index funds. The passive investor, by definition, is going to get the market return less a small expense because the index funds have very, very low expense ratios. And usually all the passive investors will be grouped together in a fairly tight distribution because they're all aiming for the same target. They're all aiming for the same market target. An active investor, on the other hand, well, by definition, is anybody who's not a passive investor. That's the easy part of it. And they also must get the market return on aggregate, because if the passive investors get the market return up here and the total market obviously at the market return, then simple equation says that on average the active investors must get the market return as well. But they're going to cover a much broader distribution because they'll be aiming for different targets. Some active investors may decide that the next year is going to be a great year for growth stocks, and some others may disagree and figure that they'd rather be in value stocks or large caps, small caps, whatever. So since the active investors don't have a uniform idea of an agreement on what to target, they're going to have a much wider distribution. You need to understand that for every trade that you make, there's going to be somebody on the other side of it, and you need to know a little bit about it. The guy on the other side or lady on the other side of it could be a professional that's managing, Harvard or Yale endowment fund, if there's some of the pension funds, mutual funds, any of these, or it could be an individual investor. And I've split them into smart individuals and not so smart individuals. I hate to call anybody dumb, so I use the term not so smart. And the question you have to ask yourself is, if there's somebody on the other end of the trade, do you have an unfair advantage over them? Do you have access to better data? Are you more experienced than they are? Are you smarter than they are? What makes you think that, if you're making a trade, if you want to sell something and they want to buy something, that you know better than they do? Usually if there's something like an 80 or 90% probability that the person on the other end of the trade is one of these professionals, and you really need to figure, are there enough not so smart individual investors to take the other side of your trade? Because otherwise you're trading against a pro, and you have to wonder if you're willing to buy, why he's willing to sell to you at your price. Chances are he knows more than you do, and you got to be careful. So the investing takeaway, just to summarize the last 2 or 3 slides, I couldn't summarize it any better than Charley Ellis. Charley Ellis is a well-known author. He's written many books on investing. I think the best known one is probably How to Win the Loser's Game. And he was on the board for, I think it was Yale Foundation, along with David Swenson, managing that foundation's long-term plan. But he basically said, if you must play the market to satisfy an emotional itch, recognize that you're gambling on your ability to beat the pros. So limit the amount you play with to the same amounts you would gamble with the pros at Las Vegas. That kind of says, don't bet the whole thing on this strategy. I couldn't have said it any better. Okay, that's it for investing. Let's move on to retirement planning. For retirement planning, we need to figure what's the purpose, what's the strategy of retirement planning overall. If you look at the life cycle, after birth, you're going to spend a couple of decades at school in one form or another, kindergarten, high school, up through college education, whatever. You reach graduation day, and then you get a job, and you spend another 4 or 5 decades after graduation working, and this is when you have all your big earnings. And at the end of the decades working, you wind up at the golden handshake day for retirement. And after retirement, you've hopefully got a number of decades of happy retirement. the cash flow for this whole period is going to be pretty lumpy, because back here all you have is a paper route, if you're lucky. Here's where all the big earnings occur, and you hopefully are earning more here than you need to live on, and you can stash some of that away so that when you get out here and your cash flow is reduced, it won't go to zero because you probably still got Social Security benefits and stuff like that. But you need to, at this point, tap into the retirement funds that you stashed away as the surpluses from this time. So one of the strategies of retirement planning is to take this lumpy cash flow over many, many decades and sort of even it out, at least to the point where you have an adequate cash flow after retirement. And we split this into two phases. The accumulation phase is this time here when you're earning more than you hopefully need for your living expenses at that time. And we talked at some point in detail about various different types of accounts, because you're usually a taxable account, and then the tax deferred accounts with an IRA or a 401k, where you take a tax deduction on the contributions to that, but then you have to pay. The earnings are not taxed at that time, but then when you start withdrawing money from it, the withdrawals are going to be taxed as ordinary income. And then the other type of account that we talked about, I call tax-free retirement accounts here, which is your Roth IRA and the Roth 401k. And at that point, you do not get a tax deduction on the contribution, but all the earnings are tax-free, totally tax-free, and the withdrawals are tax-free, provided you meet certain requirements, but they're fairly straightforward. So that's the accumulation phase. I've used the term decumulation for the reverse of that. It's probably not a dictionary word, but it is in common usage in the financial environment. It basically means you're withdrawing money now. You're undoing everything you did up here. The usual starting point for a lot of folks to determine a good withdrawal rate is Bengen's 4% rule, and there are a whole bunch of variations on that. We've discussed all those in the past, and will do again coming up at future talks. Other people use the RMD method, the required minimum distribution, where the IRS has published a set of requirements that you must withdraw a certain amount from your IRA every year. And that happens to be a good guide as to how much you may want to consider spending for that year's. Sort of like a coincidence. It wasn't intended for that, but it works pretty well for that. And bucket strategies are useful to understand at this point too, because they can help make allow you to make your withdrawals in a reasonable manner, tell you which account to take them from. So the takeaway from retirement, just to sum it all up, is that the very first most important point it would make is start saving early. You should shoot for 15% of your salary if you want to. That's a good number if you want to maintain the same lifestyle after retirement as during your working career. Initially, you may want to settle for a little bit less than 15%, but overall, that's a good target to shoot for. I really encourage folks to set up a Roth IRA for the younger people, the folks who are starting out at work, and even for kids or grandkids, if they happen to have a paper route or something like that. And it's great, and they need some income to be able to contribute to a Roth, but if they do have any income at all from any source, I'd encourage you to have them set up a Roth account to pay that into it, and you can make it worth their while by reimbursing them 2x for every dollar they put into their, from their earnings that they put into the Roth. You can give them $2 to get their attention. For the withdrawal, Bengen's 4% rule has a number of problems. I'm not going to go into them here, but it certainly isn't perfect, but it's still a darn good start. So if you find that you need to pull out significantly more than the 4% to maintain your lifestyle after retirement, you really want to sharpen your pencil and go back and look at it carefully. There's some leeway on that, but don't ignore it totally, and it's a good starting point. What happens if you're retired or halfway through retirement, then you find, whoops, we miscalculated somewhere? What are your options? Well, first thing is to delay retirement and save more, spend less. Those are all the things you wish you had done, but if it's too late to do those, you may want to consider an income annuity, especially something like a single premium deferred annuity, where at age 60, 65 or something like that, you may pay an insurance company a fixed amount and have them pay you back a certain amount every month from age 75, 85 or whatever for the rest of your life. It means that if you're fortunate enough to live into your 90s or age 100, this income along with your Social Security will continue to come. You won't run out of cash. Another option, and most folks regard it as sort of a last-ditch option, would be to consider a reverse mortgage. They had a bad name in the past, but in principle, they can make a lot of sense, and you just need to be careful who you're dealing with on it. But it's something that may well be worth considering for some people. Okay, so that's retirement planning. Let's move on to taxes. It's been an interesting few years for those folks who follow the tax world. Back at the end of 2017, early 2018, we had the TCJA, the Tax Cuts and Jobs Act. I love the way they named these. The biggest item on that got everybody's attention was that the corporate taxes got cut from 35% down to 21%. That's probably more in line with the rest of the developed world. So I don't think, probably it was overdue. Standard deduction got bumped up to 12,000 and change for a single filer and 24,000 and change for a married couple. This is basically it's about twice what it used to be. It's a huge increase, and it changes the way a lot of people fill out their taxes. A lot of people no longer need to itemize their deductions. It's just easier to go for the standard deduction, or that's something that they can do now that perhaps they weren't able to do before. The other big change was that the estate tax exclusion got bumped up again by roughly a factor of 2 to 11.4 million for singles and twice that for married couples. The problem with this is that it sunsets in 2025, so you can only count on the benefit of this if you are going to pass away between now and December 2025. That's a tough way to get a tax exclusion. The Congress may act in the meantime to change it, and it's very unclear in most people's minds just what is likely to happen. I just don't know. But for the next few years, we have this larger amount. Because of the virus situation for the last few months, we've had a number of changes that have come through. I guess this isn't so much for the virus as it's probably going to happen anyway. The Secure Act is setting every community up for retirement enhancement. The biggest thing that does is to move the RMD date out to age 72. Instead of being 70 and a half, it's moved out either 1 or 2 years to age 72. And that's probably a good thing for most people. It means you don't have to tap into your traditional IRA for an extra year or two. It can grow tax deferred. One of the things that they say that the taxes giveth, the large print giveth and the small print taketh away. What got taken away here was the stretch IRA. It used to be that an inherited IRA could be stretched pretty much indefinitely under certain circumstances, and that's no longer true. Except the exceptions, I think, are if it's for a spouse, but anybody else, the stretch IRA is gone. And now the inherited IRA account must be emptied totally within 10 years. You don't have to do it uniformly over the time. you don't have to take a little out each year or whatever. You can wait until the end of the 10th year, but at that point, you have to empty the whole thing totally. And that's probably not a good plan to wait, because then you put the whole thing into one tax year, and that's probably a hit that you don't want to work with. The CARES Act is the Coronavirus Aid, Relief, and Economic Security. I think that's a real stretch. That's just a couple of months old. And what that does is give a check for $1,200 for each adult and $500 for each child. And, you know, if their taxable income is less than $99,000. And it also gives 8 weeks, you know, a loan for funding 8 weeks worth of expenses for small businesses, defined as payroll, rent, and utility expenses. And under certain circumstances, that loan may actually be forgiven. So the tax environment is changing rapidly, and it's not that easy to keep up with. You can keep up with it, but it gets very confusing trying to keep on top of it. I've listed here a number of tax saving strategies. The first one, and the easiest one that probably is useful for everybody, is to I'm a big fan of diversification in general, and that's not just time diversification or asset diversification. It includes tax diversification. The way you do that is to make sure you put the right assets into the right accounts. For your taxable accounts, you want to use tax efficient securities in there. That's the place to put your munis. And that's the place where you can put long-term capital gains that get taxed at a favorable rate. For the tax-deferred accounts, in other words, the traditional IRAs, traditional 401k, you put the tax-inefficient securities in there, and usually this will be the low risk return assets. Usually, obviously, risk and return go together. So, you know, anything that's going to be low risk will tend to be lower return. And the reason for putting them in here is these are going to be taxed at your ordinary income tax. They're going to be taxed as ordinary income when you pull the cash out. So it's more suitable to put them in here because you're going to be paying the higher tax on them anyway. On the tax-free accounts, on the Roth IRA and the Roth 401k, you want to again put the tax inefficient securities here, but you can put the higher return securities, which would typically mean also the higher risk. This might be a place where your small cap stocks or micro caps or your emerging markets or frontier markets and stuff like that would have a good return on a long-term basis, but could be very, very volatile. And you know, the reason they're in here is that if you do in fact get the higher return from them, it's going to be totally tax-free. So you know, some folks argue that if you do a good job on putting the right securities in the right taxable or untaxed tax-deferred accounts, that you can bump up the after-tax return by as much as 1%. I think 1% may be stretching a little bit, but it's certainly worth bumping it up even a fraction of a percent by being diligent as to which securities you put into which accounts. The other thing in a totally different sense that might be useful to you is to look at bunching your charitable contributions. Since the standard deduction has bumped up so high recently, and it means that for a lot of folks, they're going to be taking that standard deduction rather than itemized deductions. And then, you know, when you're doing that, you don't get to the benefit of the separate benefits, shall we say, of taking a separate deduction for your charitable contributions. But if you want to consider bunching your charitable contributions for a few years where the total contribution in any one year exceeds the standard deduction, that might be a good strategy, where you use the standard deduction for most years, and every once in a while you lump all of your charitable contributions for a number of years into the one year, and you itemize for that year. Now, it doesn't mean that the large charitable contribution goes out immediately to all the charities. You can put it into a donor-advised fund, which lets you make grants from that fund over the years at your discretion. So you get a tax deduction for the year that you make the contribution to the fund, and then you can decide later where, when, and how you make the various grants from the donor-advised fund. So it's something to consider. Tax bracket management works for some folks. If for any reason you find yourself in a low tax bracket, it may be useful to consider filling up to the top of that bracket with harvesting your capital gains, or even doing a Roth conversion that you're going to pay taxes on that. If you're in the low bracket, you may want to take advantage and pay these capital gains taxes early. Now, usually where this is most likely to occur is on the window between the day you've retired and the day your RMDs, age 72 now, when your RMDs become a requirement. So for a few years in that gap, it may be that you find yourself in a low income bracket, and the tax rate would be lower. That might be a time to consider harvesting some of your these items. Then the other thing is tax loss harvesting. It's kind of the reverse of that. If you have at the end of the year, if you have a loss in any major security, you may want to consider selling it and taking the loss on your tax return, and then you can either buy back the same security 31 days or more later, or what a lot of folks do is buy a similar security, not identical but similar, at the time, just to make sure that your portfolio balance is maintained. So those are things to consider for tax saving. Takeaway to wrap up my ideas on taxes would be, first of all, stay alert, because there's a lot of changes going on, especially now, and we're in an unpredictable environment. I really like the notion of diversifying for the long haul, because this is just a personal opinion that Congress can't reach consensus on what happened last week, much less on what should be done for next week, next year, or next decade. There's a lot of uncertainty in Washington, and we have no idea how it's all going to wash out. So the easiest way to guard against that is to diversify. It means that you may not be a real hero, but you won't be a total goat either. Okay, on to the next of our 5 pillars, and that's risk management. Most folks think of it as just insurance. I don't want to sound like I'm really negative on the insurance companies, but basically insurance is inherently expensive. It's not their fault. It's the way that, it's the system. When you pay a premium on any form of insurance, part of that goes to cover the actuarial cost. Part of it goes to cover the insurance company's overhead, their rent or lease costs, their salaries and their PG&E bill and so on. And part of it goes for profit. They're entitled to make a profit. So when you add all of this together, the premium you pay may be surprisingly high, because these costs can easily add another 20, 30, 35% on top of this. What this means is that insurance primarily is best for a high risk event occur to insure against a high risk event with a low probability. The thing I think about here that comes to mind is the homeowner's insurance. You don't mind paying homeowner's insurance every year to cover the risk that your house might burn to the ground. It's highly unlikely that it happened over the next 12 months, but if it did happen, it would sure blow a hole the size of a barn door in your retirement plan and possibly totally wipe it out. So for any of the high risk items that you're not prepared to cover yourself, and if it's a low probability of it occurring, that's a prime target where insurance can make a lot of sense. Social Security is another form of insurance, and we talk in detail about full retirement age and the requirements for early and late retirement and the benefits and the detriments. Usually for a married couple, it normally makes sense. There'll be some exceptions, but it normally makes sense for the higher earning spouse to delay retirement to age 70 in order to maximize their benefits, because the Social Security benefits are actually it's like a joint annuity where regardless of which spouse dies first, regardless of whether it's the high earning spouse or the other spouse, the surviving spouse gets to take on the larger amount. So it's worthwhile maximizing those benefits. Medicare is a much more complicated thing than most folks figure, at least until they are charged with working it out when they turn age 65. I've put together elsewhere a chart that compares traditional Medicare with Medicare Advantage plans. There are pros and cons for each, but it's not an easy decision, and it takes a fair amount of work to get. You need to put in. You need to do that each year because it changes year to year. So it's way more complicated than I think it should be. Elsewhere, we've explored what I call the Medicare myths. There's a lot of stuff that, as Mark Twain I think said it best, it's not what you don't know that hurts you. It's what you do know that just ain't so. There's a lot of those out there for Medicare. Okay, the takeaway for insurance is you should, in general, look into self-insuring for the small things, but for the large things, I've flagged here 3 potential train wrecks that wouldn't just ruin your whole day; they could ruin your whole life. They could wipe out the best retirement plan. Well, not just retirement plan, your whole financial plan. If you got hit with one of these and weren't covered. Longevity basically means that it's great to live into your 90s or age 100, but will your portfolio survive to there as well? And one way of insuring against that is to consider an income annuity, either an immediate one or a deferred annuity. Long-term care is another thing that a lot of folks figured that Medicare covers it. Medicare doesn't, other than for the first few weeks under certain circumstances. So you may want to consider. And this is very, very expensive if it does become a requirement. So you may want to consider a long-term care policy, which might be worthwhile doing. Usually, it's best if you consider lumping these two together. It used to be you could buy long-term care policies separately, but now you can still buy them a separate policy, but there's usually a limit. I think typically maybe 5 years maximum. In my mind, that's when you want it to start at 5 years, not end at 5 years. I mean, what happens if your loved one, God forbid, develops Alzheimer's or something like that and lives for 20 years with it? How is that going to be funded? But there are annuities sold nowadays that include a long-term care rider. So if you bracket those two together, that might be one way to deal with it. The other issue is litigation. We live in a litigious society, and there are all sorts of reasons why some folks figure they can make a quick buck by suing you for this, that, or the other. And the way to cover that is with an umbrella policy. You can get umbrella policies for $1 or $2 million for a few $100 a year. They're not particularly expensive. So for some people, they may want to consider that. Estate planning. These are the main documents. I'm not going to go into those because it's best done, at some of the free attorney meetings that are available. Most of the estate planning attorneys that are trying to drum up business offer, monthly meetings for free where they describe all of these and what's going to work best. And they're obviously looking for business, but it's a good place to learn about it, and they can do all that far better than I can. So I'm going to skip over those. The probate is an issue that most folks fight like heck to avoid it, but there are some reasons why you might not want to avoid it. And we look at the pros and cons, and generally I will admit the cons usually outweigh the pros, but it is something you may want to consider under some circumstances. We've talked about being, if you're honored to be an executor or trustee, by somebody, a good friend or some of the family, it certainly is a great honor, but it's a lot of hard work and very time consuming, and the practical aspects of it can be quite onerous. The other thing we've discussed is the California right to die law. There are requirements before that kicks in, and it certainly has limitations. Now, the two big limitations that most folks don't really understand are anybody that has Alzheimer's disease or any form of disability, mental disability. They're not going to be able to avail themselves of this law, because you have to have the mental capacity to exercise your right to this. And the other area where it's frankly not useful is for somebody who's in a coma. They can't avail of this either, because their proxy, whoever they've named to make their decisions for them, can't make this decision. They have to be able to actually implement, execute their right to die themselves. They basically have to be able to push the lever themselves. Philanthropic opportunities I've included in estate planning as well, because that's when people tend to think most about it. We've defined a QALY as a quality adjusted life years. It's a new concept to a lot of people, but I think it's a useful one, an important one. And the main point I want to make here is that you can buy cheap QALYs for less than $10 a QALY in third world countries, whereas most opportunities in the US, the QALYs are much more expensive, and you can spend tens or even hundreds or thousands of dollars per QALY depending on what you want to do. It's a lot easier and cheaper to buy mosquito netting for a few hundred folks in a little African village than it is to support the foundation, for example, of your alma mater, to provide tuition grants and so on. So there's a whole range in the cost of QALYs, and you need to decide where you're most comfortable donating your money. The main takeaway on estate planning, I'd say, is just do it. It's all too easy to keep saying, well, I'm not quite ready yet, and we need to decide this and so on, and let's wait until something else is figured out. There's always excuses not to do it, but I would suggest that you actually pick an attorney and get on with it and get something on paper now, because you're going to be redoing it every few years anyway, and it's easy enough to upgrade it later as your ideas mature or even change. It may well be that that as you age, the kind of things that you want to do may change significantly. You may have different arrangements with different family members, and besides that, some of them may pass away. So your estate plan needs to be revised every few years, or if there are any life-changing things happen. And don't keep waiting until this settles out. It may never settle out. Just get it on paper now. For everything up to now, I've kind of figured that most folks can do a lot of it themselves. You don't need to go to a portfolio manager to do a good job on your with your investments, and the same thing goes for a lot of your retirement planning. You can figure a lot of that out for yourself, but this is not an area where you want to do it yourself. You need to find a good attorney, and it's going to be well worthwhile. Don't go to a stationery shop and buy some standard forms and fill them out. That the cost of making a mistake here is just too huge to even think of doing it without good professional advice. The final comment I would make on the whole thing, everything on financial planning in general, is that most of the tough decisions don't involve dollar signs at all. There's a lot more to life than just, pushing numbers around on a spreadsheet that have got dollar signs and percentage signs all over them. Life has a lot more to offer than that. So, and those are the things that are the toughest things to settle, because those are the things you need to find a nice quiet corner and go off and sit down and work through it. Okay, what I've done is give you some reading material if you want to dig deeper into all of this, along with some useful websites. And if you found anything that I've said for the last few minutes of interest or useful, please check us out. I've given you our local chapter website here, and we're on Meetup, Facebook. We've got a YouTube channel, and the national website is here. And finally, here's my email address if you have any comments or questions. And we end up with the mandatory cartoon. I like to end everything with the cartoon. This is the dead cat bounce. Question is, what number life was that? Thank you all for listening, and we look forward to seeing you back again.